Joining me now is David Zervos. He's the chief market strategist at Jefferies. Dave, let's just start with your reaction to the comments from the Fed chair. What stands out to you about his speech today?
I think you're right, Kelly. There's not too much different than what he said at the press conference last week. He was open to 50s. They gave us very hawkish forward guidance, about 40 bips more than what the market was thinking for the cumulative time to the end of 2023. I think they brought forward the balance sheet contraction in many people's minds to being live and ready to go at the next meeting. We'll learn more about that at the minutes. They left only a 25 basis point instead of a 50 basis point move. And I think that's just to kind of test the market out, see how they take the hawkishness. And the reality is, I think Jay probably sat back and said, you know what, this market took that pretty well. I'm going to keep going. I got a strong housing market. I got 1.7 job openings for every one person that's looking for a job. I've got to get this thing moving because we have a 7.9 headline CPI and we got to do something about it. So I think he's emboldened a little bit, and that's what the speech today was, a sort of reiteration of all that.
So not to sort of make you predict the tick by tick here, but do you think that investors will ultimately be able to kind of stomach this the same way that we saw the markets fluctuate last week a little bit, but then kind of really pick up steam into the end of the week? Would you expect the same dynamic to play out again here?
So, on the S&P or the equity side, we've had a heck of a run back up from the lows, whether that's just, scoring up of positions after all the quarterly witching hour stuff or the options that expired. I don't know. It's harder for me to get into those minutia, but I think the bigger picture is that the upside in stocks for this year, Kelly, is just not that high. The Fed's going to be more hawkish as we go up. They're going to feel more emboldened to get rid of that inflation story. And the downside is more risky because the Fed put, just as we've talked about a number of times, just doesn't really kick in until a lot later because of the inflation pressures that they have to continue to fight. So the risk reward is just not in your favor. And I think, as we said it last time, the Fed's just not as much of a friend as it's been in the past, depending on how the shocks all work through the system. So I think it's a very tricky time to be all in risk assets. That said, I think the growth story, the outlook for the economy is actually pretty reasonable. And I think we can withstand it, especially in the housing market where everything is booming.
Yeah, it's
Shepard Smith here. Thanks for watching CNBC on YouTube.